Hello and welcome to Stockwatch Live. With a soaring price of crude having boosted their share prices and helped propel the FTSE 100 past the 7,500 mark for the first time since October, oil majors BP and Royal Dutch Shell will be back in the news with their latest earnings updates. The oil giant shares have soared on the back of a sharp rise in the price of international benchmark Brent crude after the US announced the end of waivers from US sanctions on Iran. That in turn raised questions about the ability of other oil producers to fill the gap and helped push up the price of Brent crude, which climbed above $74 a barrel for the first time in 6 months. BP has been on an upward trajectory since the start of the year as the US has upped the ante towards Iran. But the likes of BP and Shell are of course the first to feel the effects of the push and pull of supply and demand on the oil price. And last year, after Saudi Arabia increased production towards record levels, only for the US to then continue issuing allowances to countries such as China and India for Iranian oil purchases, that triggered a slide in crude prices. Subsequent moves by OPEC and its allies outside of the cartel led by Russia to curb supply and bring the market back into balance have seen prices rising again since the start of 2019. Earlier this month, JP Cazenove reiterated its overweight investment rating on BP and raised its price target to 625 pence. Just after HSBC, also a buyer, cut its price target by 10 pence to 650 pence. At the same time, JP Cazenove also repeated its overweight investment rating on Royal Dutch Shell and raised its price target to £28.50, while HSBC retained its hold rating on Royal Dutch Shell and cut its price target to £27.30. Another sector where supply and demand is king is retailing, and British Land's £429 million sale of 12 Sainsbury's superstores won't go unnoticed. The decision by one of the UK's largest listed landlords, in a bid to reduce its retail property portfolio amid turmoil in the sector, is a cautionary tale and perhaps a sign of more things to come. For its part, it said it wants to cut its retail holdings, which make up around half of its portfolio currently, to more like 30 to 35%. The Sainsbury's stores have been sold to Realty Income Corporation, a New York-listed group. Sainsbury's will receive net profits of £133 million and will continue to operate the stores. That's not all that Sainsbury's shareholders will be bristling at, though. Broker JP Morgan repeated its underweight advice on J Sainsbury with a 190 pence target price ahead of the final ruling from the Competition and Markets Authority on the supermarket group's proposed merger with Asda. And they didn't stop there, adding that Sainsbury's full-year results, due on the 1st of May, are likely to see quality of earnings, cash flow and current trading momentum probably disappoint too. JP Morgan is forecasting £609 million in annual pre-tax profits, which is below the consensus forecast of £634 million. It concluded by saying that Sainsbury's valuation of 13 times clean earnings was still expensive, given the weak positioning and the momentum of the business. Goldman Sachs isn't impressed either, rating the shares a sell with a price target of just 225 pence, which is pretty much where they are today. Finally, after British Land's partial retreat from the retail sector into other types of real estate, it'll be interesting to hear how Into Properties is shaping up. A key feature of UK commercial property of late has been the extremely negative sentiment towards the retail sector. And that has certainly been the case for the shopping centre landlord, which is due to give a trading update on Friday. It's had a tough 2 years of it. 2 failed takeover offers, a sharp fall in its share price and sliding values across its portfolio because of declining footfall in its stores and shrinking demand for space, have culminated in the sale of a 50% stake in a Derby shopping centre as it strives to make inroads into its mountain of debt. Q8-backed Kale Street Investments is paying £186.3 million in cash for the half share. Into paid £390 million for the shopping centre back in 2014. Liberum analyst James Ashley says the deal provides some confidence in Intu's ability to dispose of assets against a tough backdrop and at a price which is in line with the December 2018 valuation of £372.5 million, giving it a net initial yield of 6.6%. Into suffered a £1.4 billion write-down on the value of its properties in 2018 and posted a £1.2 billion loss, down from profits of £203 million a year before. This deal will reduce its loan to value by 1%, But that's a drop in the ocean when you look at the net external debt, which stood at £4.87 billion, according to the figures in February's annual report. Other brokers are less positive on the stock than Liberum. Barclays Capital has maintained its underweight investment rating and cut its price target from £1 to 85p. Goldman Sachs says the shares are a sell and has cut its price target to 88p. And that's it for this week. For coverage of the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.